Hello, thanks for joining the live. If you are watching this video live, type in the chat live. If you are watching the replay or plan to watch the replay later, type replay. So I promised you a live video on a preview for my upcoming course, Accounting Basics for CEOs and Small Business Owners. So today I'm going to give you a little preview into what the course entails. So I have met with several business owners over the course of being in business 10 years. And the commonality between those business owners is they don't really understand their financial statements. So I came up with the idea to create a course for them to understand their numbers, understanding the basics of what drive those numbers, how to analyze those numbers, and how to make better business decisions based on those numbers. So don't run from those financial statements. Let me help you understand what the numbers are saying about your business. So today we're going to go into a preview on one of the sections of the course. And the course is still being developed. So if you would like to be on the wait list for announcements when it is ready, type in the chat, I want in, and I will provide you the link to the wait list. And when it's ready to be launched, you will be the first to know. So type in the chat now, I want in. So for those of you that know me, welcome back. And for those of you who don't, my name is Audra Wilson Russell. I am the owner of myaccountingcrew.com. And myaccountingcrew.com is a virtual accounting firm. We specialize in outsourced accounting, business advisory, and business tax preparation for small businesses. Let's just take a look at the current landing page for it. I want to take you here to the curriculum where there's 3 modules and several lessons within those 3 modules. Right now I have a preview on the balance sheet lesson, and that's what I'm going to be previewing here with you tonight. So it's a 10-minute, 45-second video, and well, let's jump into the preview. Again, if you're watching live, type live. If you're watching the replay or plan to watch it later, type replay. And if you want to be on the wait list for the upcoming course, type I want in. All right, have at it. Next up, we have the balance sheet. Now, the balance sheet tells a story of what your company owns, who your company owes, and the value of that company. Your assets is what you own. Your liabilities is what you owe. And your equity is the financial value of the company. The balance sheet gives you a snapshot of your company's financial health at any given moment in time. The balance sheets are like mirrors. They allow you to take a look at the past, but only over a limited period of time, only a limited view of the future. So you're mainly looking at the past, so things that you purchased, people that you owe, the value of your company at a point in time. And what I mean by a point in time is it's by the period. So as of this date, this is what your balance sheet looks like. As of September 30th, this is what a snapshot of what your balance sheet looks like. It's not like the profit and loss statement where it's over, it could be over various periods like January through December. Your balance sheet would normally be like a December 31st or a March 31st. It's a snapshot of a particular day. So on this day, what do I own? Who do I owe? And what's the value of my company? So here is an example of a balance sheet. Let me just zoom in a little bit here. We have Craig's Design and Landscaping here again. So as of August 31st, his total bank accounts is $2,001. Accounts receivable $52.81, and so his accounts receivables are his customers who owe him money. He invoiced them, now he's waiting to collect that money. Other current assets could be various things like investments. It could be a security deposit, different things like that. Fixed assets are things like your equipment, your vehicles. And so those are his total assets, $23,000. Then we get down to his liabilities. Accounts payable is the vendors that he owes. He purchased items or products for resale or just things to use within his business. Maybe he has vendor terms with them, like 30 days, a 30-day term where he buy now, pay later kind of thing. And then also credit cards. We all know how they work. You swipe now, you pay later. Other current liabilities, which could be payroll liabilities. Perhaps he's withheld taxes from his employees' paychecks and needs to pay that later. Or it could be a loan that's due within a year. So those are the current liabilities. So the accounts payable, the credit cards, and the other current liabilities makes up the total current liabilities. And then there's long term, because liabilities are broken up between current and long term. Your long term are liabilities that are due over a year. So that could be a vehicle loan with like a 5-year term or a 7-year term. And then we have the equity section of the balance sheet. His total equity is $76.61. And so based on the definition of what we know about equity is it's the total value of the company. So right now his company is valued at $76.61. Okay, drilling down into the asset section of what the company owns. So some examples of assets could be your bank accounts, of course, your checking, your savings, your accounts receivable, the customers that owe you money, and those current assets. In this example, we have an inventory asset. Perhaps you purchased inventory for resale. And then we have something that's called undeposited funds. That's money that you've collected, but you haven't quite deposited in one of the bank accounts yet. So there's a little bit of a timing difference between when you collect that money and when it's deposited into one of those bank accounts. That's called undeposited funds. And then here under our fixed assets, an example here is the company truck. Now let's hop over to the liabilities and see what the company owes. In this particular example, we have accounts payable. So remember, those are vendors that you buy now, you pay later. For a credit card example, we have MasterCard. And for other current liabilities, we have Board of Equalization payable, which is payroll tax related. So in here, they owe the state $370 for those employer taxes withheld. And then there's a loan payable, which means that this $4,000 loan, since it's under current liabilities, is due within 1 year. For the $25,000, it's a note payable, and this note payable could be a note on the vehicle, or it could be a note on a loan that was given to the business. And again, with long-term liabilities, therefore liabilities that will exceed a year or more. Now, drilling over into the equity section. So the equity section is going to be the financial value of the company. And so the total equity here is 7661.04. So one of the things that could make you have a negative opening balance equity is when you connect your bank account for the first time to an accounting software. and you've had transactions that started before you connected it. Let's say you connected with a date as of March 1st. If you had any transactions on that credit card prior to March 1st or on that bank account prior to March 1st that you didn't bring in, then your accounting software is going to automatically create an entry called opening balance equity. So work with your accountant to make sure that you fix the opening balance equity whenever you connect a new bank or credit card account, because you could be missing out on some very valuable and healthy deductions when doing so. And so let's see your retained earnings. So right now his retained earnings is 0 because this is his first year in business. But remember, we talked about retained earnings being your total of your net income from all of your prior years in business. Your net income is pretty much the current year's earning or loss. So for the current period, so 1676 is the current net income. So when that next year comes around, that 1676 is going to roll up into retained earnings here, and this number will start over again from 0. So remember, net income is for the current year, retained earnings is for all years prior, the net income from all years prior. All right, so this brings us to the end of our balance sheet. We're going to jump into a checkpoint for here. What I would like for you to do with this one is to run a balance sheet. Run it from your accounting system. Look at your equity section, and then tell me, what is the amount of your total equity in the company? What's your company's value? So take a look at the equity section, make a comment here in this lesson at the checkpoint to see if you pinpointed your equity. Now, once you do this exercise and you see that you have positive equity, awesome. If you see that you have negative equity, what this could be an indication of is that you have losses over the years, and so those losses are continuing to accumulate, so you have like a negative retained earnings balance. Or you could have too many distributions coming out of the company. With those distributions, they are considered draws, so like equity that you're taking out of the company, and that can throw your equity into a negative balance. So one way to kind of increase your equity in your company, or the value of your company, is to increase your operating activities, generate more revenue to increase your net income. That's going to create an increase in the equity. More sales, less expenses, less personal draws from the business. That will all